Okay, I'm not sure how this is going to work. I have, for some crazy reason, got all excited about a case that I ran into, a Harvard Business School case that I ran into, and I saw how it was taught in, let me just say, a prominent MBA program. And this case is named Burton Sensors. It's a fake little case. The numbers are so messed up, it's unbelievable. It's a typical Harvard case that is frankly not done very carefully. But in this case, now in this case, I'm going to be talking about Iris, who's done all the modeling for me. She's learned how to do this. She signed up for a class. It was really a 2022 class, and I didn't change the thing. She even paid, and then she's learned all about. She's an engineer who's learned all about finance by going through this case and some project finance cases. Now, this is supposed to, I'll do a preview. This is this is you can get her work both on a project finance model and a corporate model that's part of this case in here. Now I'm going to try to go through this case and see how it even relates to this book I'm reading, because it's got so much in it. In this case, here's the way it starts. Now, the Harvard Business School's secret police, my God, I'm probably going to get in jail here, but I'm definitely not allowed to let you download this case that I did pay for. I paid a lot of money for this case, like $5 or something. Okay. And it says on the case that it's sent to me. But I'm not sure I'm allowed to do this. The Harvard secret police might come after me like they have before. The There are three issues in the introduction to this case. Three issues in the introduction to this case. And one is a capital budgeting problem. Should they purchase new machines? Should they make a new capital expenditure? How would you assess a new Capex? I think it's pretty obvious. And I don't think we need a big corporate model to do that. Should they issue new equity? And that involves valuation of the equity. You have to make a valuation, and that that raises all sorts of questions. How would you value this company? And in particular, rather than getting all caught up with things like ungearing or unleveraging and leveraging the betas, which was what was taught in this class, it's really about terminal value, how you account for Capex to sustain the business. What happens if the growth rate changes? What you do, or should you use a value driver formula? What's the right way to compute terminal value? And then another one as an M&A case. Should we acquire another company? Now, and then this is clearly not a real case. I looked up Burton Sensors. There's no such thing. There's another company in Indiana that seems to make these things, and or they probably buy them from China and resell them. Who knows what they really do? But I don't think it's. Do you think this is a business where you can make a really, really high return? Maybe. You've got to think about this. Now, in this case, they gave you the shittiest model I've ever seen. They put actuals combined with forecast, put some numbers in, fixed numbers in, had some calculations in the middle, had some calculations from the historic numbers, and then they gave you a forecast. Now, what you can do with this case is you can just grab the Excel from this case. Now, I think I'm allowed to give you the Excel from this case, and then you can kind of pick out and compute free cash flows. You can look at the debt to capital ratios, things like that. Okay. But a big part of what I suggest doing is making a good financial model. Now, the first issue, even before they do this, they have kind of a financing issue. And let's, this time, I'm not sure how this is going to work, but I'm going to try it. So we have Burton sensors. These are the numbers. They gave you some exhibits, okay? And here's, for example, exhibit 2 was the income statement, and they give it like this. And then they have some formulas here. Where do they have, these are all from the sales. How do they get the sales? Or they put hard-coded sales in, and then they put a number down here for the revenue growth, and then the revenue growth went down. So they kind of gave you a model. Control Alt C, and let's just look and see what I'm taking this out and taking this out. Let's kind of see what they gave you in terms of just a minute. Stupid thing with the video on. So we have some numbers that come from another sheet. Who knows? Some numbers that are just input, which is fine, I guess. No dividends per share. Some basic kind of assumptions. Not very complicated, but really nowhere good enough. Now, what Iris did is she made a good model, and in a good model, you can look at different scenarios with different sales growth, different margins, different Capex, different assumptions about working capital, and we can look at different cases and see what happens to our value per share with different cases and try to evaluate whether we build these machines or not. The way that works is some of these inputs are carefully structured in a different sheet. We make a forecast model where we make it totally flexible, meaning that you can, if the historic period changes, if you've got a new balance sheet, then this historic data will move to a forecast. We went through that. We have a terminal period and a valuation period. We start with financial statements. We don't mix up the past and the future. We use those financial statements to walk step by step through some assumptions. These assumptions, if it's a green number, they come from a lookup from the other sheet. We work through the Capex, which is again completely done so horribly badly, but we work through the net plant, and we use this kind of if statement that I showed you in another video, and use the closing balance. Oh, no, I'm going to get bothered here. The closing balance, which comes from the balance sheet or the opening balance plus the Capex minus the depreciation. They made the Capex as a percentage of the depreciation, which is, I'm sorry, the Capex is a percentage of the sales, and then they made them go way down, okay? But then they said, oh, maybe we have to spend some Capex on this equipment so we can just change the assumption, this is without, and put the extra Capex and try to see what happens to the value of the company. And then we work through all the working capital, and then I made another video where we work through all the financing and show you how to link up the financing. And finally, we put our financial statements together, which now have the history and the forecast, and you can look through those. I think that the big deal again is in in the cash flow statement, which is down here, see what happens when the cash flow is positive, when it's negative, and do we build up cash or do we pay down debt? And the big issue here was they were financing this whole corporation by, number one, not paying dividends. So the equity implicitly goes up. You can almost say that's financing with equity if you're not paying dividends. And they're financing essentially long assets or they historically had financed the Capex with short-term bank loans, and then the banks were moaning at them and saying it's not good enough. Now, if you notice, there are little numbers. This is number 18, this is number 19, this is number 20, and then I put some return on invested capital here. And now we can start looking at things. So in this video, I'm talking about the results much more. Now, if revenue growth was number one, there was a little number one here, okay? That's just a drop-down box making it number one. And then in this, when we put the assumptions in, you just put a little one next to the item. Here, this is the historic and projected revenue growth. And then you do a match. This is a match, and I say you can use XLOOKUP. I guess we could have used XLOOKUP here, but we do a match, and we match that one and find that that's in row 76. And once we find that that's in row 76, we make a little index that goes down to row 76. This is here, and we find that column J is the first a model period, and then we can see, well, they grew really fast. They wanted to grow 1 year, and then they're tailing off their growth. Their growth is it's not 6%, is not nothing, but they're growing. And then if we kind of go down, then we can look at their cost of goods sold percent. Now, I'm going to try to go back and forth with some, again, just complete BS. This says, this says, when the bank initially, it expected the industry would experience a shakeout. What in the hell does that mean? I suppose that means that some companies are going to go bankrupt and maybe there's surplus capacity in the industry and nobody's earning a decent return on the industry. That's what it seems to mean. And if that's happening, then and weaker companies would exit, and stronger firms like Burton, oh, that's a wonderful firm, maybe they got a Harvard MBA, they would remain. And they would expect to increase. How in the hell do you know this? There is no basis for any of this, but it's really interesting, and it's the fundamentals of valuation. If you expect returns to increase, the value is higher, because you basically could look at a PE ratio or something like this, and if the rate of return is increasing more than the market is expecting it, if you have this great knowledge about the industry, then a company might be whatever, undervalued, whatever. You would think you're going to make an investment like that. It's really about projecting returns, and more specifically ROIC, which they never mention in this case, never compute in this case, never talk about, but it's the center of so much. And then they talk, however, Burton's sales growth out. What in the hell does this mean? Well, you got sales growth and cash flow growth. Okay, revenue growth, I suppose, is faster than cash flow, because you've got to make Capex and you've got to make investments in accounts receivable and inventory and all that stuff. Means nothing at the end of the liabilities were 5 times its net worth. Again, a meaningless number. And bank loans were 96% of accounts receivable plus inventory. Okay, maybe if you've got some kind of asset-backed loan and want to finance that with the working capital with the short-term debt and long-term capital. And then they said, oh, the bank doesn't want this. So here, let's just look at this. Now if we go to the, maybe you could have done it with their model. This one is the cost of goods sold to the and we got the history and projected. If the price is going to increase, the cost of goods sold should go down. And they didn't make that assumption. If there's some kind of shakeout of all the other firms, that's what really drives this cost of goods sold percent is a way to think about pricing. So they didn't have that in the case. And then they have some other things, the same sort of things. If the price is going to go up, this SG&A percent should go down. It went down a tiny bit, but basically they had real simplistic kind of assumptions. Now, the real thing is if you get down to the Capex, they said we could continue to grow, and the Capex as a percent of sales was 5-6%, and then it goes down to 1%. And you know what I didn't do? I didn't make a graph of here. We've got some extra space, so I'm going to do a little bit of this. So I want to see, for me, the real lesson in CapEx is CapEx to depreciation. And I think I did this. Now, if you go to these one, I've got up to line 20. So I'm going to make 21, and I'm going to find, this is where we're going to talk about valuation, and I'm going to find CapEx to depreciation. Okay, and I think I put it in, where did we put these little numbers? I put these little numbers in C. So this is going to be 21. I just put a 21 here. And then again, just a minute. Did I just screw up? Oh, come on. Do I have the, what's my formula option? I have automatic. Why didn't it give me 21? Just a minute. And am I recording? Oh no, I'm all nervous. Oh, let's pump. Okay, I think I should have put it in column D instead of column C. Sorry about that, because I looked and I said, match against column D. So now I've got a little drop down box, and you can see how that does. And now I can look at my CapEx to depreciation, which went way down here. Now, if we're valuing this company and you're spending, your CapEx is less than depreciation, you'll never be able to grow at all, really, if you're not making any investments, I would think. And is this number consistent with that sales growth? How are they increasing anything at all if they're not even spending money to replace their depreciation? So that's a little bit of an overview. And again, if you use a model like this, you can kind of see what's going on. Then we can look at accounts receivable and crap like that. And we can look at our total CapEx. And now if they eventually would be buying this machine, we can see what it is. Then they made this really big CapEx. Okay, so we can kind of see what's going on and then see the implications of that. Okay, so that's in this case. The CapEx is such a big deal, and these Harvard cases kind of practically ignore it. And if you don't get that right, you don't have a chance in valuation. You really don't. Okay, so, but then let's look at the implications. Then they keep moaning about this short-term debt. And here's what happened to the short-term debt. It went up, and they said, it went up too high. But if you look at the debt-to-capital ratio, the debt-to-capital ratio was going down. And what's really happening is that it's just they're financing with short-term debt. Do they really need to make an equity financing? Why do they need to make this equity financing? You can look at their debt to EBITDA as a ratio of the credit, and if you're talking to your mother, this says how many years of EBITDA does it take to repay the debt. It's not really that good because you got to pay interest and taxes. EBITDA doesn't have interest and taxes taken out, blah 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 blah. So you can look at free cash flow, but it's essentially a timing thing. But these are getting pretty good, and these were really bad. Okay, so that's our base case forecast, and I hope you can see, this is how you should do a model. For me, that's a big part of the case. And I'm gonna start teaching, and I'm gonna teach. My dream is to teach in Ukraine when the war is finished. I'm sorry to be that crazy, and you better come if somebody can get their company to pay for it. Now the next question is a valuation question. Should we? They said the value of the stock was 4.75, and basically they say somebody came and offered 3.5 per share. What's the value of this company? And that's where things start to really get crazy. So they could have a private placement of equity. The first implication is if you take their forecasts and where's our, well, this is our short-term debt and this is the debt divided by receivables. Do they need it? I don't know if they need it. You could issue equity and then start paying dividends. Maybe that's what you want to do, but do you really need it? So now let's go to our model, and then let's go and oh no, I've got to take my call. Oh no, just a minute. Okay, where was I? Oh, we're making a valuation. So they gave us this 4.75 price. Now, again, I didn't redo the coloring, so that should have been an input. Their EPS. What I do here is put a little flag for the last historic year, and then just use a sum product on that little flag to get the EPS, so we can look at different years in case we change the years. Here's the price. So the PE ratio is 20 on the historic, but don't, now in the next year the earnings were supposed to go way up. So if we made this kind of a little bit, this one 0 and this one 1, and did it on the next year, then the PE ratio is only 12. So it's whoops. So some of these things in the case are worth talking about. We can multiply the price that they thought it was worth times the number of shares to get the market value. We can add the debt, get the enterprise value, the EV to EBITDA. Again, the EBITDA, where is that? That's just down here. Just a minute. From our free cash flow, the EBITDA was supposed to go from this to this. It was supposed to dramatically increase because of that growth we were having, and we were earning the same kind of margin on the growth. So the EV to EBITDA is here. Now, then we're going to make a valuation. To make a valuation, in this MBA class, they got all worried about deferred taxes. How ridiculous is that? But we take the tax away on the EBITDA, we take working capital, Capex away, and we get the free cash flow. Now, this is criminal. I think this is criminal. In that case, they kind of gave you some hints. In that case, they said, oh, look at this. We said the equity premium was 5.8%. How in the hell do you know that? That is the most unknown, subjective, absurd number. A lot of people say that's 2 or 3%. Some crazy people who testify against say it's 12%, but they're complete jerks. I'd say about 4% is 3.5 to 4%. Damodaran, has his idiotic studies. Ooh, he pisses me off. And then they said the risk-free rate was 3%. So you're supposed to go down here, and you're supposed to look probably at the other companies, which they had this thing here, and then they had a couple of companies with equity betas. Now you're supposed to be all fancy and adjust this, unlever and relever the beta. What a waste of time. And what a incredible waste of time to compare this tiny company here with these companies. I would want to get a company that has a similar kind of return and a similar kind of size. And maybe if you look at that, okay, these are somewhere a little bit above 1. Okay, so maybe you can. So I put these silly cost of capital numbers in here, but my proposition to you my problem, I put 1.2 to get an equity beta, and then I put a 50% capital. If you think wasting your time and doing a fancy kind of market, what a goddamn, the whole problem with finance, it really is an enormous problem. Is we don't know this cost of capital. I came up now with a whack of a weighted average cost of capital of 6.61 if we use this. But you know, if I made this so if we can show the sensitivity to this here, and I almost should put a 58 and reset this to the base case and put a range name. I'm not going to do that right now. Okay, so if we take their forecasts basically, and if you just take the EV to EBITDA only of these, and the trick here is to make sure and use false, not zeros. And when you do this with just a little if statement up here to the thing, then when you take the NPV, we had a negative number, but then they stopped their Capex, so their free cash flow started exploding. Now, when their free cash flow started exploding, then we have to figure out the terminal value, which is everything. And if we can take 1 plus growth divided by WACC minus growth to get a multiple of that final year. But when you do that, if you put the Capex to depreciation and have these low Capex and assume you can continue to grow or even just replace the assets without making any, if you've got, I put 2% growth here as our terminal growth, if you think you can get that without making Capex, what are you doing? And then you better make an adjustment to the working capital and make it a stable. So you have to go through all these things and get the stable cash flow. And I tried, and this is where this for me is the real issue. What kind of stable Capex to depreciation? You got to not only replace the old assets as they come, as they age. You've also you've got to recognize that there's been inflation since then, and you've got to account for the fact that you've got to grow because of the inflation, and then you've got to get a terminal growth, which could be inflation, but you're still gonna, the Capex to depreciation is going to be higher than this, and then I'm not going to go through this right now, but there's this whole stuff you can this whole stuff you can go through to get that. Now, so where was I? I'm getting flustered. Okay, then then we can take the present value of our terminal, and we use the same kind of idea, get a false in and take the present value up here. If this was 0, it wouldn't work. It has to have false. That's why you use a simple little if statement. You take the present value of this terminal value and you use this multiple, and you get the PV. You can look at all these. Here's the point, though. When you do that, you get a enterprise value of 16 million, whatever that is, and then you can compare that to the EBITDA the EBITDA in that period just before the valuation. You get a value per share of EV to EBITDA of 16. You get a value per share of 6. Now, if we I'll change this in a minute, then a PE ratio of 20. Now, before we get all excited about this, the other way to do it is to use this formula, which is 1 minus G over ROIC divided by WACC minus the G, and that requires an ROIC, but you get a very, very different answer if you use the kind of McKinsey method where you take that and multiply it by that NOPAT, the net operating profit after tax. You can look at that and you get a 7.75. And if you just say, oh no, right away we're going to hit our target 8% ROIC, which might be a much better way to do that, then you get a value of 4.66. So you get completely different values here compared to the value in the case, depending on what method you used. And of course, if we lower the cost of capital a little bit, then these methods start to explode. So we've got big sensitivities to the terminal growth. And that's the classic valuation problem. And if anybody thinks there's some kind of magic way to get around these things and get around these valuations, well, this almost does. This last method almost does. But that method depends on ROIC. And the thing that this case didn't talk about enough was how do we look at ROIC and really think about the company a little more carefully. And up here, I said, well, let's look at the ROIC. And here, what happens, you stop making the Capex, and the denominator gets depreciated, and the Capex don't increase the denominator, and you're still assuming you're making the same kind of margins, and you're growing, and the ROIC explodes. It shows you ROIC can be a BS ridiculous number. Is this the right kind of thing? And you can also, if you're looking at a financial model and want to see if it's reasonable, you can look at the ROE, but the ROE goes down because we're basically increasing the debt to capital ratio. So if you have a model, it's a lot better to look at the ROIC than the ROE. And those are the kind of things you people in the MBA should be really understanding totally from this case. And can you see the difference a good model makes compared to a piece of crap model? Now, let me relate this to some of my kind of ideas in this book. Okay, I'm going to try to do it quickly. So I go through the here. I go through some of the problems with finance, and the first one is if you the cost of capital is so important. If you think growth is the best thing always, that's a very dangerous thing. Sometimes it's so much better to keep calm and carry on, get a boring life, boring company, lower the risk, lower the cost of capital. Don't get into these high growth situations and thinking that growth is the only thing that matters. And certainly that has environmental impacts that I'm going to talk about. And the second thing is, how do we make an assessment of a new investment, like those thermal well machines that are in the case? And I would suggest computing an IRR. And finance people will say, that's bullshit. In fact, I have a case where some finance guy went to Amsterdam Institute of Finance and said, IRR is bullshit. Well, there's a little better way than IRR. I'll show you. And I've talked about this before. Now, the next thing is when you look at financial statements, those ROICs that McKinsey loves, that are supposed to be the centerpiece of all valuation and all strategic analysis, are ridiculous. And that's what was shown in this case as well. Finally, when we look at these PE and EV to EBITDA ratios and try to find comparable companies, which again was in this case, you just can't, it's almost not worth doing. Really. And then we're stuck with our valuation. Maybe we can find one company trying to amass a bunch of comparable companies. How ridiculous is that? How ridiculous when you're comparing yourself to somebody, you try to find maybe one person who's kind of comparable or something. Why'd you have to find this gigantic group and compute some median average and say, I'm like this group? You know, you have to find a group of one person that's similar, or you know, if you're looking for a job or something like that. Okay, and then this terminal value, it's a matter of philosophy, not these formulas. How this is the gigantic thing that was causing all our crazy valuations. How do we come up with a very reasonable way? Can we? Maybe not. And that was in this case again. And then I'm going to talk about project finance versus corporate finance a bit. And finally, in writing this book, I've chosen to do something crazy. I've tried to take it and I've tried to really say, okay, let's take a simple industry, utility distribution, electricity distribution. If there's one industry you should be able to compute the cost of capital for, it should be that industry. We got a bunch of comparables, boring companies who all do the same thing. If we can't compute cost of capital for them, we can't compute it for anybody. And I'm going to show you my testimony where I tried to apply real financial principles and how these consultants got so angry with me because they all want a higher return. And then we talk about things that are wrong with finance. And now I'm going to make another video. I'm going to talk about, they talk about, using economics and climate change, and climate change has to involve everything. And this is one of the worst vehicles ever. This Dodge Ram truck, suburban cowboy. This thing uses about 5 times more emissions than others. And I'm going to talk about how Shell oil, when they try to compute betas, it screws up. They'll never make a renewable investment, or not many at least. And why these SUV sales have exploded, and all of this. So all this stuff, and then we go. I'm just going to look at this graph. This graph, I was going to gear the whole book around this, but I've changed it completely. It's a dangerous graph. You have high growth and high return. This is what you want to be, but then that comes with high risk. And maybe it's a lot better to be here. And they say, oh, this is really bad. Ooh, low rating, bad risk opportunity to diversify. This is really bad to be. Well, the worst place to be is here, growing fast and having a low return. Here is a good place to be. This is when you get out of the business. And where is this Burton Sensors? Well, they seem to have a high return, but that return is all distorted. And are they doing anything really that special to get this high return? Or is their return that high? Can we get some other hints? And then when we go down, okay, I talk about this, basically these value formulas, and this is I've done this again, but this key value formula as NOPAT times 1 minus G over RSC divided by WACC minus K, and we prove it to you, and we prove that if the cost of capital doesn't change, I held the cost of capital the same here, that this seems to be where you want to be, but it's a really dangerous idea, and you should be, and then we go through graphs of people who've actually done that, but then we go through my uncle who had the handbag and just kept calm and carried on. I respect him. He's 91. I really respect him. We show you how sensitive the things are, the cost of capital, and then we compute IRRs, and we say, should we compute the NPV or IRR of this man named Justin Bieber? Okay, that's going to be in the case in just a minute, and then I say, no, you should compute the earned risk premium as the best way to resolve all that stuff, and this is too long. I've got to shorten this. Oh shit. And then we say the ROIC doesn't work, and we just saw that, and then I go into terminal values and all sorts of things. So this case that we're looking has a whole bunch of that stuff in. Now, let's go back to this case. So the next question, after we have this valuation issue that we can't resolve very well, should you purchase these new thermal well machines? And one of the ways we could do this, now this is kind of good. I didn't notice this at first. They didn't put this. They said, we spent 1.4 million per year. They didn't say per year, to buy thermal wells, whatever the heck these are. So they spent this per year. That's the price. Instead, they could buy 4 machines. 4 times 6, I think is 24, 2.4 million. So instead, they could do this, but then they would. This life only has a life of 7 years, and then they needed some O&M expenses of 170 and materials of this. And Ms. Marshall estimated that they need working capital. This now things for me start to come together. And there is no hint in this case of what to do. Now you could say, and here I put some stuff in, and they had an interest rate, and I even said do some debt. So I'm going to make you do a project finance model for this. Now, here's what I would strongly encourage. I would strongly encourage you to do that yourself. Now, before we do this, if we look at the different comparative companies, the first thing I did, they have net operating profit. They have a profit margin. Who gives a crap about that? They have the net income somewhere. Net income, operating profit. This could be OP, NOP, NOP, AT. No PAT or no PLAT would be after tax, and they always use the 35% tax rate. So you could look at the return, and I didn't look at the return on equity. I should have done that. Let's do it return on ending equity just to get a sense of what's going on. Now this again, the statement that this company, there's another statement in the case somewhere. So I'm going to take the net income, just divide that by the equity. That's the first thing to look at. 25%. This is pretty darn good. It came down to 17%. This one is 15. So if they say, what a joke, these are tiny little companies that don't count. We just have two comparable companies. This one had a negative one and then a positive one. Okay, this is like the equity IRR. Can you really earn this kind of return in this kind of business? Oh my gosh, if you can. And then they say the returns are going to increase. Give me a break. And then this is the growth rate. They said this industry is going to have a big growth. That's not showing up. And there's a growth here really, but what kind of long-term growth are you really going to have? These are enormous questions. Can you keep growing and compound growing? Oh my gosh. So now, don't do that. Let's see what's really going on by taking that model, and this is where corporate finance and project finance come together. So Iris did this. She made a project finance model, and I was just trying to show her to make sure that you can do it. And she did it really quickly. We put a 7-year life in. We put the revenues, and those revenues, that's a reflection of the revenues are the cost you don't pay, but you could look at it from somebody else's perspective. They're selling these things to Burton sensors. They're selling these. We got to pay some Capex. We got to pay some OPEX. We got to pay some working capital. And then I put some inflation in here. You don't have to put inflation. If I put 0% inflation, this is going to be a disaster. We'll show you. And then you have a tax rate, and I said, well, the depreciation for taxes and books is be the same, and let's even put some financing. That's what we need for any project finance model if we do it really simple. And then we can just make a construction period, an operation period. We go to 7 years. We put our revenues in. We inflate the revenues and do it really nicely with kind of this stuff. And then you get your EBITDA first, and you put your Capex, and you put your working capital investment that you get back later. Iris did this whole thing, and then you get your free cash flow before you get all fancy with equity cash flow. And our rate of return is 6.52 pre-tax, not after tax. And if we go to this one, that silly little whack calculation we made here, I get emotional. Well, that's 6.55, but that whack is a blended average of equity and debt, and it's basically an after-tax calculation. So we go down and we put our depreciation in and we pay taxes, and our after-tax IRR is 4.31, and this is numbers from the case. Now, the question is, did these people who made the case want you to find this? And this IRR gives you the real number. Now, if this is all you make, on these in this kind of industry, because it's a reflection of really what kind of capex you have to make. Somebody's selling them. It's got the capex. Number one, the ROICs, either they're doing something very different, or maybe this is just a little part of the business or something. But this is evidence. If you're an investor, this is what you want to see. You want to see if I invest profitably in new capex. If I can't grow. And if I can't grow, my business will kind of go down to nothing. And maybe these things are all built in China, and that's why you can't make a profit. We've got to figure this out, and then we can even put financing in, and we have to reflect the tax shield, and then we get a 4.95% on equity. This is just from the case. And if anybody says, oh, IRR is bullshit, well, maybe, okay. But what I do then is I also compute put the risk-free rate in and put the NPV at the risk-free rate, see what kind of premium you earn over the life. We earn 16% over the premium, and I levelize that out and get a 2.6% earned risk premium above 3%, and that's on the pre-tax numbers, and that's not very good pre-tax. And I think that's a way in the future, if people will start looking at earned risk premiums and not have this problem with the IRR where you reinvest at the IRR itself and have all of this headache around that. And if this Mr. Probably from Oxford who taught at the Amsterdam Institute, if he was thinking, well, I would want you to compute the risk premium you actually earn, that would make sense. But if he's saying, oh, let's compute the cost of capital and estimate the NPV, what kind of bullshit is that? And he's the one who used that term, and I even put his email in my book that I haven't. Wonder if anybody will publish it. Okay, so that's for me, this is it. And then if we say, oh, here's the problem. If I'm going to compute my value, and if I'm going to in my valuation, if I'm going to try to take the distortions away, that we get a really high return, over where this was the ROIC, we get this high return because we're just not replacing our assets. These returns are just so distorted by the things becoming older and older and older. It looks like we're earning a return, but our assets are getting so old, and one day we're going to have to replace those assets, and when we replace them, we're going to have a gigantic ton of depreciation, and this is going to come shooting down. And if all that we can get in an IRR is something like 5 or 6%, these kind of numbers look much more like the long-term prospects. And so we go to our financial model, and I hope this is completely different. And we say, oh no, I can only earn something like a 6%, and then my value per share really tumbles. And maybe we should take that man up on his offer to pay 3.5% per share. Okay, or if we say, oh, maybe we can earn 7%, it's still not a great picture. And that, remember, that was less sensitive. I should have maybe put a little spinner box about around the terminal. Oh no, I don't want to do that, because the terminal ROIC, and when we don't use the McKinsey formula, when we are is that the one I've been using? I think I just manually put that in, and I've got to correct that. Okay, and I'll stop here. Now, there's another part of this case for M&A, and I think I'm going to stop this video right now, and I'm going to stop this video, and we'll deal with that last section in a separate video. But in a way, that's why this case is it could just be horribly written. It could just be horribly written because you've got ROICs all over the place. You've got crazy depreciation assumptions. You've got no semblance of logic for the capex to sales. I mean, there's so many things wrong you can hardly start. But the fact that we have to compute an IRR to look at our capital investment, the fact that we have to this moaning about the bank loan was just a red herring. It's just short-term debt versus long-term debt financing. The valuation is very tricky, and the valuation illustrates that if you don't be really careful about how much capex you need in that terminal period, to in this case we'd have to if we spent less than our depreciation, we should be spending a lot more than our depreciation just to replace assets because of inflation. If we're spending less, we're going to have to make that up, and our ROIC is going to come tumbling down one day. Those are the ways to think about these cases rather than just plug in some unlevered versus levered what a bunch of bullshit, or start worrying about deferred taxes, or just getting off track on just irrelevant kind of crap. Okay, so I think I was gonna not put this video up. I think I'm gonna do it. Okay.